On to another story going on right now in Washington as Congress takes up the idea of a new consumer financial protection agency. We're joined by its chief proponent, Harvard Law professor Elizabeth Warren, and she's with Lizzie O'Leary now in D.C. Lizzie, take it away.
Thanks, Betty. I'm with Elizabeth Warren, and I have to ask you, you have been one of the driving forces behind this idea of a consumer financial protection agency. Are we going to call you chairman?
Oh, you have to wait until you get an agency. You have to remember, I have a job.
Well, on that job, one of the things you're doing right now, I have to ask you about this. You're the head of the Congressional Oversight Panel for T.A.R.P. One of those T.A.R.P. recipients, Citibank, we've got reports they're going to double their salaries, base salaries by 50%. Can I get your reaction to that?
You know, I just have to say, these guys just don't seem to get it. They're taking taxpayer dollars in order to keep this business alive, and yet they think that when Americans are out of work, when people are struggling, when this comes out of taxpayers' pockets, that they can double their salaries. This is more about, does anyone understand what's really going on here?
Well, let's talk about consumers. Let's talk about this new agency. One of the things you say in your testimony is that you'd like to see plain vanilla financial products in there. Does that mean that we will see things like interest rate only mortgages go away? Does that limit the range of credit products available to a wide range of borrowers?
I don't think it limits the range of things available to, 95% of people. Let's face it, there is an underlying truth here. If you can't explain it to someone, then you probably shouldn't sell it to them. So this is really about most of what most people need are two-page credit card agreements, two-page mortgage agreements, and that will make most of the market work cheaper and be much more competitive because people can compare from product to product. There's a place in the market for more complex arrangements, but they're going to require a lot more explanation.
National cap on credit card interest rates?
Oh, I don't think we have to head in that direction. I think if consumers can look at 4 credit cards, and unlike today, where that would be more than 100 pages of incomprehensible text, it were just 2 pages, 2 pages, 2 pages, 2 pages, and the interest rate, the penalties, what triggers a penalty is all very clear. It'd take about a minute to figure out which is the least expensive, which is the highest risk one, and how much those free gifts are really costing. The market itself, if it worked right, can take care of a large part of the high interest problem.
Okay, I think Betty has a question for you.
Professor, this is Betty here in New York. I just wanted to jump in on that because, a lot of the banks, they've come out in criticism of this new agency, and they're saying that this will only increase costs to the consumer if they are put under greater scrutiny, like what you're talking about. What is your response to that?
Betty, that's really not what this is about. This is about reducing costs. Right now, there are 7 different federal agencies that own some piece of the consumer financial regulatory system. The idea is to bring all that into one place, cut out the duplication, frankly, cut out the part that doesn't make any sense, offer some safe harbor, off-the-shelf, cheap products for what will be a large part of the market, and then concentrate on getting regulations that really work on the more complex products. The total costs for regulation in an environment like this should be much, much lower.
Can I ask you then, though, that does bring up this question of separating the agency that is regulated by one regulator versus a product regulated by a different regulator. Take the Federal Reserve, take a bank holding company. How do you expect those two things to work together, those two agencies to be squared together? Isn't there a potential for risk between maybe not judging systemic risk if the product is being regulated over here and the agency over here?
Well, I think there are 2 responses to that. The first one is that if we keep putting risky products into the system, which is what we are doing now, it's what brought on this crisis, one household at a time, we're pumping more risk into the system. So systemic risk regulation actually starts by doing these cheaper, easier products. So I think that's the key to what's going on. The second is, let's face it, the regulatory agencies said they were protecting the banks by letting them issue all of these products. They were focused on their profitability. That didn't work out so well for us. It turns out that doing these lousy products was not only bad for the economy and for the families, the banks are going broke. So I think this one has proved to be bad system.
Professor Warren, thank you very much. We're out of time. Betty, I want to send it back to you in New York. We'll hear more from Professor Warren when she testifies at 10 o'clock.
Okay, Lizzie, thanks so much.